Copy. Good morning, folks. Let's do it. What a great energy we got on the floor today. Welcome to the Streets opening bell here from Post 35 on the floor of the New York Stock Exchange. Today is Thursday, the 15th of September. I also don't know how it's already mid-September. I'm your host, JD Durkin. Opening bell rung just moments ago by Corebridge Financial. This next part of the sentence is not something you hear oftentimes these days. For their IPO, there's been a 7-month lull. It's the biggest IPO to date. Corebridge, of course, is AIG's life insurance and retirement division. They raised $1.7 billion on Wednesday, the biggest IPO so far this year. Obviously, braving market conditions. This is not a very friendly IPO environment for many companies. Not the case today for the folks at Corebridge. You will see over my shoulder the biggest crowd here on the floor that I have seen in quite some time. Congratulations to the folks over at Corebridge. And thank you for bringing the energy on this Friday Eve. Quick check of the big board here, just a few moments into this trading day. Get a sense of what we're looking at. We do have across the indexes opening down. Similar story for the Dow, the S&P, and the NASDAQ currently down 0.6%. We had modest gains across the indices yesterday. That include, of course, a late day rally here on the floor. We watched as the big board went from red to green really in the last 10 minutes or so in the trading session. The Dow, S&P, and NASDAQ all finishing higher in yesterday's session after, of course, that significant sell-off across the board the day before. We've been talking about that ever since. Let's take a look at what is on tap for this morning's show. We kick things off with a look at what is moving the markets, especially, of course, on the backdrop of fresh retail sales data. We'll be diving in to help you understand what it means for you. Plus, strike averted. The White House announcing that after marathon talks, were they ever, a tentative deal has been reached between freight companies and major rail unions. And finally, the CEO of Disney striking a bit of a bullish tone on parks. And yes, he did address that whole ESPN thing too. Remember the Dan Loeb controversy? Don't worry, folks. We got all that for you and so much more ahead here on the show. We now turn to the only person I would want to talk to in a situation like this, our senior editor and markets correspondent, Mr. Martin Baccardax. Martin, thank you for taking the time. Good morning to you. Pre-market here was a bit of a mixed bag. Just 2 minutes into the trading session, Dow down fractionally, S&P, NASDAQ all down fractionally. What is top of mind, you think, especially now that the dust has settled a little bit from where we were a couple days ago?
Yeah, an investor described it, I think, pretty well overnight, JD, when they talked about stocks being kind of in a no man's land right now. Essentially, what we're seeing is economic data isn't sufficient enough in terms of its advance to change the metrics on earnings generation going forward. Yet at the same time, we're simply not seeing inflation dynamics slow to the point where we can feel comfortable about the Fed pausing its rate hike cycle. So when those two components collide, you're not going to get a great deal of upside in stocks. What you are going to see is the defensive equities rising to the top and the more risky ones, of course, sliding underneath. And I'm going to guess that that's what we're seeing this morning without looking at the board right now. Probably a mirror image to what we saw yesterday, where we might grind higher, but probably won't claw back the losses from earlier this week, probably for a number of sessions. You know, solid retail sales this morning, some decent numbers with respect to manufacturing output and things like that, but just not enough to move the needle. And ultimately, that's sort of where we are into this September month. And as we talked about earlier this week, JD, that's the toughest month for stocks, and it's proving so again this year.
It certainly is. Currently speaking here, just a few moments into the start of the session, looks like we've got 3, 4, 5, 6, 7. Only 7 of the Dow 30 currently trading up in the green with regards to the 11 sectors. 9 of those 11 currently in the red, though they are trading fractionally. Energy, the big laggard there. Health and consumer discretionary, the only 2 of the sectors in the green, at least just a few moments into this Thursday. I do want to get your sense on retail numbers. We had a good bit of data that came out at 8:30 today. I want to talk specifically about retail sales. What did we learn and why is it important, Martin?
Well, this is a solid number, I thought, for the month of August. Effectively, we saw a 0.3% increase from July for total retail sales, somewhere around $683.3 billion spent, according to the Commerce Department. It's an important number because what we saw was retail sales rising despite gasoline sales tumbling quite quickly. Gasoline sales standalone were down 4.2%. Now, that's on a value basis, not a volume basis. So it's not that we're buying less gas. It's just that, gratefully, we're paying less for it. And therefore, the assumption was retail sales at the headline level would fall as well. But they actually did nudge higher, and that's important for a couple of reasons. The first is that it does seem to suggest that consumers have a bit more money to spend in discretionary parts of the economy. That might be why you're seeing that sector rise early on the Dow this morning. And it also indicates that the gas price decline is probably going to give consumers that kind of spending breathing room into now and the end of the year. And that will be critically important heading, of course.
Mark, we just lost that far ahead briefly.
But we certainly are. Oh. There were some mixed components. I know. Oh, are we back?
Oh, I got you, Martin. Go ahead. Continue, please.
Oh, good. Yeah, I cannot believe that we're talking about November spending already, but here we are. It's like having the Halloween decorations up in August and the Christmas ones up sometime in the middle of October. That's sort of where the market's eyes are right now. A mixed bag, in the data this morning. Auto sales were a big portion of the bump, it has to be said. Gasoline sales, as we talked about, were a big portion of the fact that the discretionary spending was also increasing. But when you look at it on an annual basis, JD, retail sales are up 9.1%. Inflation is up 8.3%. So we're only modestly ahead of the headline inflation number. So we're not climbing in any great significance in terms of spending power. And the nominal number gains that we're seeing are largely as a result of that broader inflation dynamic. So it's decent. It's not great, but it is suggestive that at the very least, the demand component of the inflation story is legitimate. What would be more worrying, JD, is if we saw inflation surging and demand not following underneath. Then we would know for sure it's a supply chain issue that would be a lot more problematic for the Fed. At least seeing these numbers today, we know that the Fed understands this inflation dynamic much better than it did the previous one, which was all about supply chains and energy markets. This is a bit more traditional and therefore more likely to be handled properly by the Fed as a result.
Martin, is it too early to put out Halloween decorations at any point in September? Is October 1st the appropriate mark? Because CVS already has them. You can get Halloween candy.
I'm seeing it in CVS, I'm seeing it in Target, I'm seeing it in Walmart. Probably indicates that I spend too much time in all of those institutions. But yeah, there's a lot of orange and black on the walls.
But listen, what a great story, though, because you're not alone. I think a lot of American consumers are in those institutions, and that's oftentimes where they are spending money. There's an economic component. You thought this was just a Halloween question. No. We're digging down to where consumers are putting their cash. But it is a little jarring, right? Because you walk in, you're like, I don't want to see all these skeletons. And suck. It was just Labor Day. Come on, can you just give me a few weeks?
You raise a good point, though, JD. What I didn't really necessarily appreciate in the retail sales numbers this morning was the bounce that you get in store sales as a result of the Amazon Prime Day, which was in July. So Amazon Prime Day is going to boost non-store sales as a result of all that online activity. When that falls off, you see actual proper store sales increase as a result. So it was fascinating to me to watch that ebb and flow of the way that we spread our dollars around as a result of not only some of the marketing campaigns, such as Halloween and beyond, but also what we are seeing from the great online retailers and the more powerful ones like Amazon and others.
And of course, we're all going to cringe invariably watching a football game in the not too distant future when that first holiday season car commercial comes on with the little jingles. We're going to say, "Not yet, please. Please give us until at least to get through Thanksgiving." This is the part of the year that just absolutely flies off the calendar, right? It's like you kind of build up towards the fall, and then it's just like, and it's February. So speaking of this issue of consumers, it's downhill. That's it. So with regards to this conversation about consumers having money to spend, the truth is, I would argue, I think a lot of people are, Americans are still flush with cash. That's been the story in the era of easy money, so to speak. And they're still spending, this despite rising prices. I wonder if the Fed has been hoping for a pullback specifically in consumer spending, especially as we get close to next Wednesday's meeting.
Yeah, that's a dangerous game to some degree. They do want to tamp down some of the demand, of course, because consumer spending is such an important component of U.S. economic growth, 2/3 by some measure. But You know what, JD? I'm not the one who has always been convinced at the idea that American consumers are flush with cash. Yes, the job market is certainly as resilient as you could expect in the wake of a pandemic. But wages are simply not rising to the same pace as inflation, and therefore we are getting squeezed in terms of our take-home pay and what we need to buy. It's also worth remembering, and we talked about this earlier in the week, food price inflation is at the fastest since the late 1970s. So basic goods are significantly more expensive, and that's eating away at a lot of our discretionary spending. We can't, of course, decline to look at the enormous amount of consumer debt that Americans have had to take on over the past 10 to 15 years, and that's approaching 3 and 4 trillion and beyond. So I do think that consumer spending is certainly stronger than I expected it to be. It's probably in the range that the Fed would feel more comfortable with, given that it's rising but not surging, and that's exactly the kind of soft landing that they're looking for. But I am not amongst the group that suggests that the American consumer is flush and therefore going to be the key driver of growth going forward. I just think there's a lot of dynamics underneath that suggest maybe our spending habits are changing. We're going to be looking at paring down debt, particularly as interest rates continue to rise. And job markets, while resilient, aren't nearly as comforting in terms of long-term employment prospects, particularly when we look at some of the layoffs that are planned by the big companies like Goldman Sachs and others.
Yeah, the wage component is such a good part of that conversation. I'm glad that you appropriately raised so. There is huge news, and this was the sort of story that I think a lot of people maybe had not been paying attention to in recent weeks until it was everywhere. And that is the, well, now likely not going to happen, railroad strike. There's more, I's need to be dotted, T's need to be crossed. He did have all-night talks that included Labor Secretary Marty Walsh. All right, we got to some solution. We've got there. What do we know about what's been agreed to upon?
Now, history doesn't always repeat itself, but it does rhyme, I think. An important man once said. I'm trying to remember. It might have been Oscar Wilde, but I'm not entirely sure. But there was a wonderful West Wing episode from about 20 years ago, JD, where the trucking industry was basically locked in the White House for marathon talks in order to avoid a strike that would have crippled the fictitious economy of the Bartlett administration. And we're seeing something similar here in the sense that we had 24-hour talks in the administration that were indeed aimed at thwarting this rail strike, which would have taken place at midnight tonight. So essentially what happened was a tentative agreement was brokered between union representatives and the rail companies, certainly at the behest of President Joe Biden, who interceded around 9 p.m. last night, according to reports. Now, we don't know the actual detail of what was agreed. And the fact that it is tentative means, of course, that it's going to have to be fleshed out by both union reps and therefore ultimately ratified by union members. But nonetheless, it takes the midnight deadline off the table and gives all sides a bit more chance to explore options and opportunities in terms of coming together for a full and ratified agreement. Now, the administration did this earlier in the summer by having an agreement that was not yet ratified, but close to it for 115,000 members. Last night's discussion was more focused on around 60,000 of them. But nonetheless, it does appear that we're going to have that strike averted, at least in the near term. And then if the administration were smart, well past the midterm elections as well. It was good news. It lifted stocks a little bit this morning, but until it's fully ratified, you can understand why investors are a little bit more tentative, pardon the pun, with respect to the headline readings.
First of all, for whatever it's worth, I when you said that, my thought was, oh yeah, that is definitely an Oscar Wilde quote. It sounds like an Oscar Wilde quote, something Oscar Wilde would have said or written in his wonderful work. However, it is frequently attributed to Mark Twain. But I think it's one of those things of there's all these websites of things Thomas Jefferson allegedly said or wrote that aren't really Thomas Jefferson quotes. I don't really know if Mark Twain said it, but it is it's a great quote nonetheless. Also, I didn't know this about you. You're a big West Wing fan. I too am a big West Wing fan.
It's really one of the best bits of episodic television I've ever seen. I would say West Wing and Breaking Bad are probably, A and A1 on my pantheon of the greatest shows of all time. It's endlessly entertaining. There's a UK program as well, which is called Yes, Prime Minister, which has elements of the West Wing with a lot more comedy. I certainly recommend anybody who's watching this to take a look at it, because the issues that they deal with in a show that was filmed in the early 1980s echo almost with absolute clarity today. And curiously, that's the same with the West Wing as well. Most of the things they talk about, we're still debating. And that either says that we're not going anywhere or that we're advanced to such a degree that the problems just remain the same. I'm not wise enough to discern the difference between the two.
I admit I'm not familiar with Yes Prime Minister. I will certainly add it onto my queue to consider checking out. If you're a fan of the West Wing, it sounds right up your alley, so I look forward to checking that out. To stick here with the railroad conversation, I want to take a look at part of the statement here that the White House released on behalf of President Biden. This is the early morning hours earlier today, and this is speaking to the quality of life debate about this once upon a time imminent strike. And here's what the president had to say. He said, quote, "These rail workers will get better pay, improved working conditions, and peace of mind," says the commander-in-chief, around their health care costs, all hard-earned. Martin, what more do we know about what both sides are getting out of this agreement?
The details still need to be fleshed out, but there certainly is going to be a component with respect to wage increases, a bonus in terms of hiring retention. But one of the sticky points that hasn't been sort of reported on and will likely be a component of discussions as we reach from a tentative agreement to a ratified one is paid time off. It's very difficult for rail workers to find the proper time off to do quite a few things, including doctor's visits, banking, and other personal sort of aspects of their lives that are still critically important. The workers wanted around 15 days of dedicated paid time off. I'm not entirely sure whether that was agreed upon last night. And again, we'll get the details going forward. But that does speak to what you sort of indicated with respect to the president's comments, in that it is to a degree about quality of life and working conditions in many ways. And those things trump the salary increases, which very often these negotiations get stuck upon. So it does point to not only the fact that the president sees this as an incredibly important section of the U.S. economy, and that's absolutely true, but that there's a human element as well. And I think when you mesh the two and come together with an agreement that both sides seem to agree upon, that's unambiguously good and positive for the economy itself.
I want to take a look at another part of the statement here that the White House released on behalf of the president. And this largely gets to the parts of the economy. And I'm curious from your perspective, what could have gone wrong here? Here's what the White House continues to say. And it was a lengthy statement, by the way. The president said the tentative agreement reached tonight is an important win for our economy and the American people, even if there's no strike Friday at midnight, even if this period elapses and things are back on the rails, quite literally, so to speak. What disruptions, I wonder, did we already see? Obviously, we had this announcement from Amtrak, but I feel like it extends far beyond that.
There were definitely some disruptions with respect to potential deliveries. If you're somebody who has a load of goods, and again, I'm simplifying, that you needed to get to a further destination and you believe that there's going to be a rail strike, there was an excellent chance that you were going to pull that back and look for alternative transport, either in trucking or air freight. So we're very likely to see minimal disruptions, even with the aversion of the strike, but nothing near to the concerns that we had with respect to a $2 billion a day hit to the U.S. economy. Because ultimately, when we talk about freight transport, we're looking at about 30% of all goods that are moved in and around the biggest economy in the world. And that's just simply not something that can be dismissed in terms of its impact. So I think the president is correct in talking about this being a big win in terms of the economy. Whether it's one for the American people is probably something that will be debated by others wiser than myself. But it is important in certainly one political distinction, and that is the impact on inflation that could have been stoked by the supply chain disruption is going to fall away, or at least it's not going to materialize. And that's going to be critically important for the administration heading into the midterms, because they absolutely need to see inflation on a downward trajectory in order to maintain some kind of confidence in the broader economic policy. If that were to be spiking, even as a result of a strike, which is a bit of a force majeure, voters would be very reluctant to believe that the stewardship of the economy is something that the administration can hang its hat on. So I think from a political point of view, this is absolutely a win, at least for the Democrats.
I do want to talk Disney here, because I think these comments from Bob Chapek are very interesting, and they're not just relegated to parks, though that is the part that I certainly want to start at. We talk about where Americans are going to put their dollars in this inflationary environment and what the interest rate impact is. But Mr. Chapek seems to think, hey, I mean, a lot of people are going to be booking that trip down to Orlando, making some bullish predictions about parks at a tech conference that he spoke at. What else did Mr. Chapek have to say?
He was really bullish on the parks. There's no question about it. That has been a bit of a drag on Disney earnings over the last couple of years, and it's perfectly understandable because we've had pandemic restrictions on visitors, not only in the United States, although they have drifted away, but in international parks as well. And he was adamant that they're seeing solid demand both internationally and domestically in the parks division, and that's something that investors have been looking for quite some time. He was also talking about the standalone proposition of ESPN, which I thought was really interesting because we spoke about this earlier in the week. There have been activist pressure to explore a sale of that sports division, the sports cable division, in order to generate enough cash to pay down debt, give the broader Disney umbrella a bit more flexibility. But Chapek, he didn't necessarily like that idea. Curiously enough, he was able to push back on Dan Loeb. He runs the Third Point LLC hedge fund. It manages about $14 billion. He managed to push back against Loeb's demands for the ESPN sale and a couple of other things as well. And that does suggest that he has a good plan in place if he's going to change the mind of somebody of that caliber who went public with his suggestions and then retreated from them shortly after. That's not something he takes lightly or does very often. So it does tell me, at least, that he has confidence in Chapek's plans. He sort of reiterated last night during the conference that was the case. He was very bullish on ESPN as a division within inside the unit in the way that it can grow Disney Plus subscribers and also in the way that they feel they can leverage off sports betting and sports gaming going forward.
So that's actually exactly where I want to take the conversation. The interest in his ESPN comments, of course, in light of the Dan Loeb back and forth of the last couple of weeks. Chapek indicating he still thinks it's best placed within Disney, perhaps more broadly. But the sports gambling part is really interesting to me. Obviously, this is a world that has been embraced by the major sports leagues, by famous alums and previous professional athletes who are absolute superstars. You can't go 5 minutes without watching TV without being bludgeoned over the head with a sports betting ad, and I understand why. But it's really interesting, though, to have a representative of Disney sort of indicating that sports betting is a part of the equation, isn't it?
Yeah, well, Disney, exactly. I mean, from a corporate brand perspective, there's nothing more pristine and sort of, family orientated than the Disney brand. And for the CEO of that company to be talking about something like gambling is really quite extraordinary. If we had gone back 10 years and had this same conversation, it would seem sacrilegious. Today, it just seems par for the course because, of course, we've come so far and so quickly with respect to the mainstream embrace of sports betting that it just doesn't seem that scandalous in any way anymore. And, I would probably have to agree that it is. Ultimately, though, how is Disney going to do this? How is ESPN going to do this? I think, and I wouldn't say this for sure, but my suggestion is that sports gaming is so statistically driven these days and sort of powered by bettors' understanding of data and all of our better understanding of data with respect to sports in general, that ESPN will be able to use its incredible trove of statistics and information overlapped onto the highlight packages it has and the sports rights that it already owns into some of these fantasy gaming sites that will allow people to ultimately maybe even pay to participate in and then leverage that into sports gaming itself. I think at the moment, everything is kind of moving at a speed in which no one is able to predict where the ultimate outcome will be. But I do think the fact that you have this sports data overlaid onto sports entertainment is exactly where you would want to be in a new gaming environment. And I think that's why Chapek is so bullish on ESPN's potential inside the Disney umbrella as a result.
Yeah, I mean, I think you'd be forgiven if you viewed this as a little jarring to have someone in Chapek's position atop the House of Mouse openly talking about this new age world of sports gambling. But again, I understand why. It's just going to be a really interesting thing. It's been really fascinating to me to watch the sort of legacy names around sports. Of course, the NFL sort of viewed it as a third rail for many years, sort of don't touch it, don't talk about it. And now it's the exact opposite, right? You can't sit through a broadcast without being reminded of the shifting odds as the winds of the winds shift over the course of a game. Oh, now this team's now favored. Head on over to FanDuel or whatever it is and put in your wager. It's a fascinating conversation. Mr. Chapek also spoke about the agreement to buy 33% of Hulu. Of course, Hulu is owned by Comcast. that's interesting because Hulu is very closely tied, of course, to the world of digital distribution, to streaming, to live sports, which of course is incredibly important to Hulu. And I'm curious what more, if anything, he had to say on the Hulu side of things, because I think, Martin, that is going to be of significant interest to a lot of investors looking in from the outside.
Hulu is going to be ultimately, I think, the biggest piece of the streaming media puzzle going forward. Who actually controls that is going to be critical for who is going to control the ability to grow streaming subscribers in the coming years. Disney owns 2/3 of it now. They have an agreement in place to buy the final 33% by January of 2024 from Comcast. Comcast, for its part, has the Peacock streaming service, but it's not growing to nearly the potential that they would like. So you can understand why Comcast is going to want to demand a significantly higher price than the $27.5 billion that the stake is valued. Now, in order for Disney to cement its position in the global streaming market, and they've only just overtaken Netflix as of the last quarter, they're going to need to get Hulu fully on board. Now, the question is only going to be, how much is Disney prepared to pay for that stake? As I mentioned, the $27.5 billion valuation is a minimum. It doesn't necessarily have to be sold to Disney. There could be other companies that come in and bid for that slice. So if Disney wants full control, it's probably going to have to pay significantly higher than that, and it's going to have to do it in a time frame that is ticking away quite quickly. Comcast doesn't seem to be in any hurry. Disney would like to get it wrapped up sooner rather than later, and that generally drives the price even higher. It'll be interesting to see who comes in underneath with another bid as well. But for the moment, at least, Disney does appear to be in the driver's seat. Right now, it's just about price rather than timing.
Martin, I can't help but wonder, to any degree you're comfortable sharing, because I'm putting you on the spot here, but I'm of the world right now where I've cut the cord years ago, as more and more Americans have been doing for a long time and continue to do. And so now I'm in this dizzying array of a world where I have Hulu, I have Netflix, I have HBO, right? And like the subscriber costs add up month after month, but we're in a situation where you have to now spend so much to get every individual streaming company. And I'm curious if that's the way that you consume whatever it is that you're watching. Is that how you consume news when you watch football, when you watch tennis? Is it on one of those streaming giants? And are you as equally in a fog as the rest of us when it comes to this dizzying array of seemingly never-ending options in the streaming world?
Yes, economists call it creative destruction when you have these big changes in underlying structures. And that's exactly, I think you're right, what we're seeing. When people did cut the cord, the assumption was they were going to be able to save significant amounts of money and still see all the content they want. There's never a free lunch, and I think we were all naive to believe that. But right now, I think you're absolutely correct. There's a bewildering array of online streaming options. We all have a piece of a bunch of them, and as a result, most of us are actually paying more for our streaming each month than we were on our basic cable bill. Now, that's not apples to apples, because we have been able to select the content that we would like instead of having it come downstream from a singular provider, and that's certainly very important. But until the market shakes itself out to a point where consumers can be comfortable believing they're paying a consistent price for the broadest array of content that they can imagine, you're going to see this sort of the chaotic change. And that's why I believe you saw such a significant decline in the Netflix subscriber base this year, why the Disney numbers were much more quickly advancing than economists had predicted, and why all of us are sort of toing and froing and tinkering with our online options to get it just right. But I'm exactly like you, JD. I have probably too many online options right now than can be justified, but I'm just reluctant to cut them out, because even if I'm paying a certain amount of money each month, there's one or two pieces of content in there that I just can't live without.
And the quality of Disney Plus programming is really important. Obviously, Disney gets to leverage the incredible strength of Star Wars original programming and the MCU, Marvel original programming, which I think they've done a really incredible job, just as a viewer consumer standpoint, of instituting new shows that roll out, and they've made it must-watch appointment TV on Disney Plus. We've gotten almost away from this era of just the we're going to dump 13 episodes, you watch them when you want. Disney Plus helped kind of bring back this era where it's like, oh, now I got to sit there every week and wait for the next episode, and I can't wait to watch it. And part of that is the demand, and part of that is just the quality of how good the product is that Disney has, because they own the access now to Marvel and Star Wars, like two of the biggest things that human beings have ever created. It's no small beer, if you will.
I think
Yeah, did I use small beer correctly, more or less?
Excellent.
I'm working on it.
Excellent.
Yeah. Oh, yeah. I mean, of course, you're right. In addition to everything else that they have, ESPN and sports. Okay, time now for our morning rapid fire section. A handful of questions, topics, open things we're wondering. First off, for you, Martin, what is the merge, and why should we care?
What is the merge and why should we care? It's not the Meg, it's the merge, and that's an important distinction. Now, if you are watching this as a crypto expert, I do plead a little bit of rope in terms of the simplicity in which I'm going to describe this. But essentially what you have is a blockchain that underpins the Ether digital token. It's not dissimilar to Bitcoin, but it is unique. They are merging, or at least they did last night, they merged that blockchain network with a secondary blockchain network to bring them together to create what's called Ethereum 2.0. Now that will underpin, again, all transactions that take place in the sort of the ecosystem of the Ether digital token. It's the second largest cryptocurrency in the world. It's responsible for about a fifth of digital coin transactions, and it's approaching Bitcoin's dominance in terms of its common everyday usage. The big reason why this is important for us is because of the anticipation that the energy used to validate transactions on that blockchain is going to be about 99% cheaper than it would be under the old system. So that's better than for the environment, and ultimately more efficient and reducing of transaction costs.
Next up, Adobe is buying Figma for a price tag of $20 billion. Big deal or not a big deal?
I think it's a really interesting deal, and I do think it's a big one. 20 billion is a big price tag for a company that doesn't really have a great deal of cash on hand. So ultimately, how they're going to pay for this is going to be something investors are going to look through. But it does sort of indicate Adobe's ambitions to try and expand its niche in the cloud services market, and sort of the way that it hopes to leverage off hybrid work. The collaborative systems that we use on Zoom and in other sort of applications are all part of the Adobe package, and they're part of Figma, which is basically a design platform. It's used in Zoom Communications and Coinbase and some other places. But the stock is down this morning because investors don't know precisely how the cash is going to be raised to ultimately close the deal. And Adobe forecast near-term sales that were just a little bit shy of street forecasts. But that's not unusual. Adobe is pretty conservative in its forecast, so the stock price reaction might be more about the deal than the broader market projections from the company. But I'm interested to see how this is going to get paid, because I do think it's an interesting move and an interesting slice of the cloud space economy.
It certainly is. All right, let's move on to number 3. Is Microsoft's takeover of Activision now in doubt?
Feels a little bit so. The UK Competition Authority has moved from an initial probe into the $69 billion deal, which would see Microsoft take over Activision, which makes Call of Duty, Candy Crush, and a bunch of other very popular games, into what's called a phase 2 investigation. And that could take several months. They're very worried about the impact it would have on the broader competition conditions in not only the UK economy, but around the world for video games. So it not only increases the likelihood that Microsoft will have to make some remedies to make those watchdogs happy, but also that other competition authorities around the world will want to put their oar in the water on this deal before it closes next year as well. I don't know that it puts it in doubt, but it certainly elongates the time frame and does probably mean that Microsoft is going to have to do more to satisfy regulators than it has already. The deal's probably going to get done. It's just not going to get done at the time that we thought.
We've been waiting all week for Thursday night. We got football tonight. Kansas City and the LA Chargers going at, sometimes I don't know. I sit there and it's like LA Charger. It doesn't roll off the tongue for me as much as San Diego still does. But the Los Angeles Chargers, of course, the team we're talking about. Who you like tonight for Thursday night football? Chiefs favored right now by 4.
Yeah, I was surprised by that. I think the Chiefs are probably going to have a bit more success, particularly at home, than the bookies are anticipating. The over-under, I thought, was interesting as well, somewhere around 54 points, I think. So we're probably looking at some kind of shootout. But in those big marquee games, Patrick Mahomes is just always so dynamic and so exciting, and really rises to the occasion, that I don't doubt he's going to do it again tonight. But this is great, not only for the NFL, but also for Amazon, which is streaming this live. And this will be an interesting sort of component of how they're going to be able to pull viewers in, and whether viewers can actually find the game tonight when they go looking for it. And this might portend sort of their rise in influence in sports rights streaming, but also just it's going to be a fun game for the rest of us.
The over-under is currently set at 54. For whatever it's worth, Kansas City alone in week 1 against Arizona put up 44 points. That was certainly an over game, with Arizona putting 21 on the board as well. The Amazon thing is really interesting to this. I know this is rapid fire and we got to finish it up, but I've been watching several of the New York Yankee games, which they take off Yes Network. I think there's about a dozen to 18 games or so in the season. And suddenly Yes Network here in New York doesn't have those Yankee games. You got to go on over to Amazon Prime. That to me has been an interesting experiment. And I'm curious now, with far more national eyes that will be on this game tonight, what this looks like for the future. And I'm almost certain that they're going to expand MLB offerings. I mean, they're really trying to make themselves a sports destination. But as with everything else, when Amazon decides they're going to do it, it's hard to bet against them, right?
That's just it. And I think Amazon wants, more than anything else, more and more reason for us to come to their platform and stay there. And there's no better way to do that than with sports rights, because, of course, it's a time demand situation. Nobody records it and then goes to it later. You have to go there on time, and you have to stay there through the competition. And that hopefully will mean that you stay on the platform and buy things whilst you're doing so. So this is an important thing for Amazon, and an important change in the way that we consume sports going forward, I think, as well.
Absolutely. Well, I will be at the Mets Pirates game tonight. It's Roberto Clemente night in Queens, so I will be watching Amazon Prime on my phone, like a lot of other people will, to get updates about how Patrick Mahomes performs. Martin Baccardax, thank you for taking the time. What an awesome show and broadcast we got to have today. Great to have you here on the show.
Thanks,
as always.
JD.
That's going to do it for Opening Bell here from the floor of the New York Stock Exchange. Stick with TheStreet.com for more on these and every other major market story that mattered to you. We'll see you later.